is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, Kyle Ryan, as always. And today we are going to have a conversation about tax planning for business owners. And this video in particular is going to be more of a preface to some individual guide points that we're going to dive deeper into throughout the remaining part of the year. We just kind of wanted to focus on, I would say, Kyle, a rough overview of some really important things to consider as a business owner when it comes to doing tax planning for that business in particular. And to kind of highlight what we're going to talk about today, looking at really honestly doing or delegating really good bookkeeping on a monthly basis. The second thing is taking a look at opportunities to maximize your qualified business income and decrease the amount of self-employment taxes that you pay. So this is kind of a tightrope that you're going to walk as a business owner, depending on the entity structure, which we'll talk about as well, that you are deciding to utilize, and how you're going to incorporate an owner's pay or a salary within that entity in itself. The third thing is really taking a look at trying to incorporate business expenses that provide benefits to your employees that also provide tax benefits to you. And then lastly is really looking at other opportunities, maybe kind of outside the business, more of a side hustle like opportunity that you can provide yourself tax benefits that will then decrease the overall income tax that you're paying yourself as a business owner. So Kyle, would love to just kind of get your initial thoughts on this conversation in particular.
Yeah, I think you phrased it really well. It's going to be an overview on a lot of these things because if we dove into any particular one in depth, like, entity structure, that could be a whole episode on its own.
Yeah.
So what we want to do is, provide enough information to be dangerous, hopefully glean some interest, and, hopefully shed some light on ideas for business owners to save some tax money.
Yeah, let's dive right in. So bookkeeping. I think this is something that is getting talked a lot about more recently because the software that's coming out has gotten so much more effective and efficient and providing what I would call base level bookkeeping. It's really starting to get into a mode where it can start tracking your transactions, but also assigning those transactions to specific categories of how your business operates. And I think that's a really great start, is utilizing that type of software. But the second part is actually reviewing on a consistent basis, even monthly if possible. Kind of depends on where you're at in the size of your business and how much time you actually have available to do that. Sometimes that needs to be delegated, but actually like evaluating what month to month spending inflow and outflow looks like, and also recognizing opportunities in certain transactions to recognize tax deduction. Because the first thing that we want to talk about is you don't want the tax tail to wag the dog, meaning you don't want to be making decisions solely on the idea that it's going to decrease your taxable income, because you're actually going to end up hurting yourself at the end if you're too tax cognizant on the upfront basis, not necessarily on the lifetime taxable situation of your business. So it's that, but also just providing a lot more clarity in how the business is operating on a month-to-month basis.
Yeah. And let's talk about why bookkeeping is so important, right? Because as a business owner, let's just say you make $1 million. You need to record your expenses to come out with a net profit, because that's when you're going to get taxed on. You don't get taxed on your million, you get taxed on your profit, right? So the really important thing about bookkeeping, and the real good reason to do it, is because the better you keep your books and the more you can write off legally, is the less taxes you pay to the government. So solid bookkeeping can save people thousands of dollars. Lazy bookkeeping can cost you thousands of dollars. And how you mentioned it, if you're doing your own bookkeeping, I always suggest to clients, if you're doing it yourself, just put in, a little bit of time, on the weekend, whenever you have free time. Don't let it kind of clutter itself up too much, because then it becomes this daunting task that either doesn't get done or doesn't get done well, which both of them are really poor things to be done. The amount of times we refer someone who's been doing their own taxes to a CPA and they just go through, fix the books, and save them a few $1,000s is incredible. Yep. So with that being said too, we had a previous episode about delegation. If you don't have the time or the ability as a business owner to get your books kept properly, proper bookkeeping, we would really recommend you reach out to either a bookkeeper, CPAs, accountants sometimes do it, but making sure you have proper bookkeeping is a great way to keep some more tax dollars in your pocket.
Yeah. Yeah, definitely. And I think kind of moving on here outside of bookkeeping and progressing a little bit is like, firstly, we want to make sure we're keeping an eye on where things are going and where opportunities are. The second thing is kind of progressing more into how are we actually going to have the business flow from an income perspective to the business owner, the employees, things of that nature, that is the most tax efficient, where we're maximizing that qualified business income deduction, which is going to be 20% of, Kyle, correct me if I'm wrong, is it adjusted gross income?
Your 20% is profit.
Yes. Profit.
The
That's what it is.
profit from the
Okay.
business. Yeah.
My bad. For some reason, I was blanking on that. So 20% of total profit versus self-employment taxes, which is going to be the employee and the employer side of Medicare and Social Security, right? So trying to increase the QBI and decrease the self-employment. And I want to have you talk through this because your mind is a little bit better on this. Is how can we incorporate a mix of some salary and a mix of taking some profit to maximize that? And obviously, you don't need to provide an example by any means, but just kind of talk through how somebody can evaluate something like that.
I like examples, makes the numbers go down a little bit easier.
Yeah.
So let's separate two things really quick too. If you are a sole proprietor, single owner in your business, doesn't really this conversation doesn't really relate to you, because any profit you have is when you have an S corp, when you have a sole proprietorship, a lot of these different business entities, they're called flow through entities, which means that all the income flows through your business and goes to your personal tax return. So if you own a business on your own, it's gonna all get taxed to you all the same way. There's really not much you can do about it from this perspective. But if you're like an S corp, right? So the company I work for, we're all an S corp here. You can separate what you take as salary and what you take as profit. Now, we're not going to go too in depth in this because there's a lot of nuances here, but it's really important to understand that what you take as salary as a business owner, right? I am as the business paying someone a salary. Now, as a business owner, I'm paying my side of the self-employment tax, right? 7.65%. As the employee, my salary, I'm paying it again, another 7.65%, as you mentioned. So I'm paying 15.3% self-employment tax, as well as all the other federal, state, local taxes, what have you. So that's like a W-2. Most people understand the W-2 because most people are W-2 employees.
Yeah.
The other end is profit. This is where the QBI, the qualified business income deduction, comes into play. Okay, so say I have $200,000 of revenue and I pay myself a $120,000 salary. Means I have $80,000 of profit.
Yep.
Okay. There's a lot of really interesting ways that you can work out the math to determine how much you ought to pay yourself. I got to be careful here because the IRS, there are tax codes. If you're like, how much should I pay myself? I just won't pay myself anything because I don't want to contribute to Social Security.
Yep.
No, you have to.
You.
No, the IRS says based on if you were to hire someone doing exactly what you do, how much would you pay them? It's how much you should pay yourself. If you're managing a business, then you can really say, okay, I really deserve some profit here. Typically, profit will get treated better from a tax perspective because of that qualified business income deduction. So there's just, we'll leave it at that. It's just, there's really this intricate game you can play to a certain extent of how much you pay yourself versus how much you pay yourself versus how much you keep in profit as a business owner, which can really, really make the difference from a tax perspective and how much you owe. If you don't play the game, you're never going to get ahead. And those who know the rules of the game tend to play it better. So if you're in this situation where you're paying yourself a salary, taking a little bit of profit, trying to figure that out, certainly recommend you speak with your accountant and or your financial advisor to kind of figure out that medium ground on where the most tax savings is.
And the reality is in that node, you're normally wanting to evaluate these things on a fairly consistent basis. I would say, and depending on how much your income is growing or receding, obviously kind of depends on the stage of your business, but you normally want to look at this once or twice a year, in my personal opinion. Because let's say that last year you made $100,000, but you're 6 months through the next year and you're at 250, right? You probably want to reevaluate how you're actually putting together that salary plan in order to make sure you're staying on par with what you're trying to accomplish. And I think that's something where having frequent conversations with your advisor and your tax professional, that's definitely, something that I would recommend as well.
Absolutely, because then you're playing the Social Security game, right? Because Social Security only gets taxed to a certain threshold. So you're able to say, okay, well, once you pay yourself a salary here, it actually kind of behooves you to pay yourself a salary there because you're no longer paying that self-employment tax. So you're right. There's a lot of things, a lot of games to be played once you're, a business owner, I shouldn't say games we play. There's a lot of opportunity for tax planning as a business owner.
Yeah, absolutely. So kind of moving on to the third part is trying to incorporate business expenses that can be considered as employee benefits that are also recognized as tax benefits for you. And I think as a financial advisor, kind of hammers to nails here, the first thing that we think about is a retirement plan, some sort of 401k plan. I think that's just kind of the part of the nature of our conversation, but in the industry that we work in. But at the same time, this is a really great place where you can leverage a lot of tax credits and tax deductions and keep kind of quote unquote keep your own money. Also allow your employees to keep their own money as well. And what I mean by that is with some of the new legislation that's come into place, you can get tax credits for setting up retirement plans, like the cost for that. You can also get tax deductions for some of the costs for maintaining retirement plans, but you also get tax deductions for any sort of employer contributions that you make to employee retirement plans, right? So you're getting a lot of benefits there. Don't forget, as an employer, as a business owner, you can contribute to that plan yourself and keep some pre-tax funds for your own. You know, reduce that taxable income now, push that and defer it away towards retirement and grow that money, right? There's a lot of advantages that you can provide, not only yourself, but you're also your employees that are going to be win-wins, in my opinion. Now, we obviously want to take each person's situation at face value and see what's best for them. But in most cases, a 401k plan can provide a lot of good possible planning opportunities that allows you to reduce that taxable income.
Yes, and I want to repeat what you said earlier. A write-off, maybe this is offline, but a write-off is a great thing, but it's not always the best thing, right?
Yeah.
Because say I want to do a write-off. I spent $1,000 on something.
Yeah.
And I'm like, oh, I get to write it off. Well, no. I have to spend $1,000 on something to get a tax deduction, which reduces my tax bill by the amount I spent times my tax bracket.
Yeah.
If I'm in the 20% tax bracket and I spend $1,000, I'm only saving $200 for the tax deduction. So that's the big thing, because I've had these conversations with business owners, like, oh, I'll spend money on that. I get to write it off. Well, hold on, time out. So let's go back to it. So, the most important thing with offering benefits and the number one reason people do it, offering benefits to your employees, is to, retain and attract really good employees, right? So numero uno, that's why people do it. It's fantastic. But yeah, if you start offering health insurance, a 401k, any sort of fringe benefit, and you start paying on your employees half, you get to write that off. You get to retrain and attract great talent. You get a tax deduction for doing so. You're taking care of them, the people you care about, your employees. It's all important. And then as you were mentioning, the 401k side of things, offering a 401k or retirement plan is very powerful. It can be very attractive. And as long as, again, what you were mentioning is there's a lot of new laws and regulations that came out. It became really attractive. They offer tax credits, which is dollar for dollar what you put into it, for starting up new retirement plans, right? We went into this with the Secure 2.0 episode we did recently, where you give matching you give matching contributions to an employee. You get all that money back in the form of a tax credit up to $1,000. You set up a new plan, which normally costs just say $4,000. You get the plan cost back to you, credit all back. So there's a lot of really nifty things you can do, again, from a business owner's perspective, to provide tangible benefit to your employee and save you tax dollars. It's a win-win.
Yeah. And I'm trying to think if there's anything off the top of my head benefits wise that could be a really good idea, because I think the health insurance plans where you're paying premiums are great. I'm actually seeing a lot of employers, especially larger employers, is they're providing HSA matching contributions. So I think that is a really interesting way to look at providing a high deductible health plan where it's maybe not that expensive as a business owner to provide, or as expensive as something more comprehensive, and then matching with an HSA contribution, which not a lot of companies do. I think that there's definitely some added benefit there as well.
Life disability insurance.
Yeah. Right? Yeah. Short and long-term disability is definitely a good option. You kind of need a way from a employer to employee perspective. If you're paying the premiums on that, it's actually it doesn't come out tax-free to the employee if they need to utilize it. So just kind of something to recognize there. But kind of
One
transition.
caveat, one
Go ahead.
caveat on that is that if you're the employee and you're paying for it, whether or not you take the tax deduction as the employee will determine if, which I'm pretty sure is what you said, will determine if you receive your disability insurance tax free or not.
Yeah, that's essentially kind of how I was navigating that. But to second it, I think it's really important because a lot of people will think that they have, and we're just going to kind of hit this real quick on, let's say they have short-term disability insurance, and the policy quotes that if they activate their short-term disability, they'll get 60% of their current monthly income in disability insurance. Well, they might get that, but their take home, if the employer is contributing the majority of that disability premium on a per paycheck basis, they're not actually going to see 60%. Right. And so that can be something to really consider, is how much is your take home actually going to be? So that's just kind of something to recognize overall on the benefit side, is retirement plans, health insurance, short and long-term disability. Those are normally really good options. I would say access to any sort of estate planning attorney networks is also good. I see a lot of large companies that will go into networks that provide that, as well as just kind of a per paycheck, expense right there. Last thing is, trying to get a little creative with out of the business side hustles. And I think the most popular one right now is having material participation in rental real estate. And normally you're seeing that as a spouse who isn't working, because the business owner is primarily going to be the breadwinner, is having that spouse that isn't working do the material participation on rental real estate ownership. And you have the ability to utilize the expenses, deductions, depreciation of that rental real estate business against the active income that you're receiving on the business that the other spouse is actively participating in.
Very similar to that. I've seen a lot of businesses have a separate, LLC that owns the building that they work in and
True.
rents to the business pays
Yep.
them. So the business gets an expense for the rent. The outside entity is basically its own, rental, realty corporation.
Yeah. I would say kind of like one major disclosure that I would say, and I've had a couple of conversations about this with some different people, is be very careful the strategies that you're implementing. If you're seeing them off of a Reddit thread, if you're seeing them off of a YouTube video, if you saw it off of a Twitter thread, a Twitter tweet, even LinkedIn, there's a lot of gurus out there. There's a lot of some fake gurus who are just pushing out an idea that is not the IRS level standard for, I would say, legal tax deduction strategies. It's more evasion. And we definitely want to steer clear of those types of opportunities. I won't necessarily mention any, just so that we can stay in the clear here. But just kind of the idea of, hey, consult a professional tax advisor with certifications, designations, credentials, professional experience before actually implementing any sort of strategies that you see, even with us, right? Yes, we are professionals, right? But always get a second opinion on how to implement something, and if you should implement something, before you actually do.
The only thing I'll mention is, if you're going to pay your kid, would you pay another kid to do that job? Because we see it all the time. Pay your kid $6,500, contribute it all to the Roth, and it sounds glorious until you end up in an IRS tax court.
Yeah.
So, yep.
And the reality is,
again, just hire a CPA. If you're really ever unsure and you want clarity and you want insurity, hire a CPA.
Yeah, I think there's a lot of truth to that. Do you have any other kind of out of the box ideas?
Yes. Taxes. As a business owner, you got to pay taxes. Sometimes you do not get a paycheck. Not all business owners get paychecks, but you still got to pay your taxes. So most people pay their taxes in the form of a paycheck. Every time I get money, gets withheld. As a business owner, if you do not have a paycheck, you still have to pay taxes. You have to pay probably quarterly estimated taxes. So if you don't know what that is, we don't have to go into it here. But if you do not if you're not withholding taxes on a regular basis, because the IRS wants their money all throughout the year, you have to send in quarterly estimated taxes. And I would strongly recommend you work with an accountant on doing so. And yeah, there's other things you could dive into, but it's probably a little more nuanced for this, cash balance pension plans. You mentioned HSA. So there's a lot of cool things that business owners can do to just really be savvy with their taxes, keep more money in their pockets.
Yeah. And I think, just to kind of summarize this, recognizing that you can do so much more if you bring in professionals to your team, right? That do this for a living and operate in this area on a daily basis, where they can recognize and build in opportunities for you to save money on taxes, but also just be more efficient with your business, right? Most business owners are very, very good at the specific thing that they're doing, and they've been doing it for a long time, right? Recognize that you can't always be an expert in everything, or you don't always have just as much time as you should or could delegate to something like this, and push it to somebody else who can, to maximize what you're doing. I think it's kind of that one step back to go 4 steps forward, right? Is especially in this situation, you can really leverage a team that can create a lot of good opportunities for you, whether that's a CPA, whether that's an EA, whether that's somebody who's just doing your bookkeeping, whether that's a financial advisor that could help you kind of set that team up in general. I think that's something that's super important. So if you ever have any questions or have any interest in that, please feel free to reach out to Kyle or I. We'd love to talk with you about it and see if there's any way that we can find opportunities to help you and your business grow. Thank you so much for watching and listening, and we'll see you guys next week.